Debt Market Update, August 2021. The G-Sec yields traded in a range during the month and ended the month at 6.22%, up 2 basis points compared to last month. The movement in yields was driven by elevated crude oil prices, RBI increasing the quantum of VRRR by INR 2 lakh crores, dissent by a MPC member against accommodative stance, rise in US Treasury yields, etc. Average net interbank liquidity surplus increased significantly during the month, driven by foreign exchange purchases done by RBI along with liquidity infusion of INR 500 billion through acquisition under GSAP 2.0. Net FPI flows in debt increased to $1.5 billion in August 2021, following net inflows of $0.5 billion in July 2021. Cumulatively, FPI flows in debt in the first 5 months of FY22 stood at $2.2 billion compared to net outflows of $4.4 billion during the same period last year. Outlook. The monetary policy minutes released during the month were largely balanced in general, except for dissent by one MPC member on stance. Most MPC members noted the strengthening of recovery over the past couple of months, but also remained cautious about the fragile nature of it and risk to the same from the possible third COVID-19 wave. Hence, there was consensus amongst the members on need to support and nurture the growth. Further, most were of the opinion that elevated retail inflation is driven by supply chain disruption and aggregate demand remains weak. However, members noted the rising household inflation expectations and risk of it getting de-anchored. On an overall basis, the MPC continued to prioritize growth over inflation and emphasize the need to aid the nascent recovery. While quantum of VRRR was increased by INR 2 lakh crores, RBI emphasized that it is merely a liquidity management tool and should not be understood as precursor to liquidity normalization or withdrawal. Going forward, the overall fixed income environment is slightly adversely placed as factors like elevated crude prices, resilient retail inflation, high SLR holding of banks, broad-based recovery in high-frequency indicators, likely tapering of US Fed in the near term, etc., can put upward pressure on the overall G-Sec yield curve. Further, given the increase in quantum of VRRR, yields at the shorter end of the curve can rise at a faster pace, thus leading to flattening of yield curve. However, despite these factors being prevalent for some time, the rise in yields has been rather modest due to multiple factors. First and foremost, the continued RBI intervention through deployment of conventional and unconventional tools like LTROs, TLTROs, Operation Twist, GSAP, cancellation of auctions, etc. has increased the system liquidity significantly and capped significant rise in yields. Further, the government supply of bonds has been lower than earlier anticipated and risk of fiscal slippage remains low too. Further, fall in US yields and accommodative monetary policy of major advanced economies bodes well for lower yield too. In view of the above, we expect yields to trade within a range with an upward bias. However, the yield curve is relatively steep and hence we continue to recommend investments into short to medium duration debt funds, possibly in a staggered manner in line with individual risk appetite. While credit environment still warrants caution, measures undertaken by RBI as well as lower supply of bonds have eased the spreads on AAA rated bonds significantly. But we believe opportunities still exist in select pockets of non-AAA rated bonds as credit spreads are still trading at reasonable levels compared to history. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.